Well, so it's the multi-trillion-dollar question everybody's trying to find out. Look, I think it was you, Jeff, or perhaps Steve, said that one trading session in itself, it doesn't, tell you a whole lot. Obviously, there's plenty of fear in the markets. There is a huge amount of volatility. I don't think we're quite at levels of full-on capitulation yet. At least by the measures that we follow, I don't think we're quite into oversold territory right now. There's still a huge behavioral bias towards buying the dip, I think, to some degree. And let's not forget that we're still not really in a bear market. So we were overdue a correction. That's what it is. Does this get much worse and enter into bear market territory? Of course, we don't know. And the picture is very mixed, which is why, on the one hand, you've got a reasonably strong economic picture for now, at least in terms of, we're not expecting a recession and earnings are still positive. On the other hand, plenty of momentum going negative and potential issues with rate rises. So it's a mixed picture, and we're neutrally positioned at the moment, given all of those crosswinds.
Just to throw out some stats so our audience has a good understanding of where we are. The S&P closed more than 17% from its 52-week high. The Nasdaq, NDX and Russell 2K down more than 27% from their 52-week high. Tech is more than 23% from its 52-week high. You say it's not a bear market. It's starting to sound a little growly.
Yeah, certainly is. And, you're right. I mean, global equities are give or take about 16, 17% down from their all-time peak. So, yes, another, 4%, and we'll, technically be in that, full-on growl mode, right? If things are just getting rumbly now. Yeah, and that is the case. Like, obviously, but you have to put into context, right? We've had a massive rally in the year and a half preceding that. And, to some degree, we were overdue a correction, which is what it is right now. Does this enter bear market territory? Obviously, we don't know. But there's plenty of reasons to think that things aren't as dire as the last few days and this year in general would suggest. One of them, obviously, is that we still have a robust economic paradigm. If you want a job, you can get it. If you want to raise money, you can. If you want to borrow money, albeit at slightly higher rates, as Steve mentioned, 200 basis points increase in mortgage, fine, but you still can, and those rates are still historically low. So there's plenty to hold your hat, hang your hat on as far as the global economic picture is concerned.
I take your point on the pain threshold for consumers and businesses as you talk about being rational around these markets. But if you consider there are parts of the market that are in bear market territory and quite some territory in terms of some of the technology names and the fast-moving stocks that were IPO'd in recent years, and you can see that when you've got big days to the upside, some of these names actually gather more momentum. The buyers do return in somewhat of a smaller fashion to these areas of the market. But on the downbeat days, it's quickly taken away again. What do you make of that? Are you saying that people who go back into these beaten up areas of the market are making a mistake at this point?
No, look, I wish I knew definitively, Karen. I mean, we don't, right? There are clearly, there's a lot of fear in the markets, and, the buy the dip mentality that we've had for a very long time is obviously there's much more of a sell the rip mentality in this last few weeks and months, okay, particularly in the last month or so. Is that sort of just a temporary phase, and are we waiting for something to hold our hat on more definitively before we get a big rally upwards? Obviously, we just simply don't know. I mean, look, on the basis of our investment modeling, we still think that the economic regime is pretty good, and if you're a long-term investor, this is, we're not in there's no recession. It's not being forecast. So that's a good thing. On the other hand, valuations are still not cheap. Momentum is quite profoundly negative. And sentiment isn't quite at levels of full-on capitulation yet. We're not there yet, where just people want to stampede out of the exit no matter what. As you said, there's still plenty of, smaller, but still buy the dip feelings out there, at least in some parts of the market. We don't really know where this goes from here, right? Obviously. But as a result, we're neutrally positioned. We do think that there is plenty of economic support still. And that's a reason why we haven't cut risk and are not sitting completely on the sidelines, because there is there is enough there to be supported by, particularly in terms of corporate earnings as well.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.